Hey everybody, so today in this video I am going to be talking about medical expense insurance, and my goal here is to help you pass your health or life and health insurance exam on the first try. Medical expense insurance is a confusing topic. It doesn't just help you pass the exam, it'll help you and help your clients as well. So if this helps you, please also check out the other resources that I have available in the description of the video, and my contact information will be in there as well. Medical expense insurance delivers financial protection for expenses that come from accidents or illnesses. So if you get an accident, then this will cover the care that you need, or if you get sick, then this is intended to cover the care that you need. Medical expense insurance, the exact care that the insurance covers, depends on the type of policy that the individual gets. But there are some things that coverage can include: surgical costs, inpatient care, convalescent care. Convalescent care means the care that you need when recovering from surgery or an illness. Physician services, doctor services, nursing home, private duty nursing, diagnostic tests, lab work, x-rays, medications, and other essential medical procedures. So depending on the type of policy, those may or may not be covered under the medical expense insurance. Typically, medical expense insurance does not cover care that's provided in government facilities. So in general, medical expense insurance won't cover any care that's received in a government facility, like some sort of VA facility or Medicaid or something like that. There are two types of plans. There are fee-for-service plans. So this is when the plans will reimburse the insured based on the amount that's charged for the services that were received. So fee for service is like you go to the hospital and you have this charge from the hospital, and a fee for service plan will pay either all of it or a portion of it, depending on what was charged up to certain policy limits. And then there are prepaid plans. Prepaid plans are plans that pay for services in advance, regardless of whether or not the insured actually receives those services. The first type of medical expense insurance we're going to talk about is a basic medical expense policy. Basic medical expense policies, also known as regular medical expense policy or a physician's non-surgical expense policy, typically cover basic medical care regarding things like nursing facilities, rehab centers, home health care services, private nursing, hospice cares, outpatient treatment, and maybe some dental and vision care. Not all of those things are going to be covered by one basic medical expense policy. Depending on the policy you select will determine which of those things may or may not be covered. Basic medical expense insurance is often referred to as first dollar coverage. Now, first dollar coverage means that there's no deductible that needs to be hit before the insurance kicks into place. So from the first dollar that's needed for care, basic medical expense insurance will cover that. Typically, basic medical expense insurance does not have huge coverage limits. So it'll cover like right away, but the limits aren't usually high. That's for major medical expense or comprehensive major medical expense insurance, which we're going to get into a little bit. So if you got to look at it like basic medical expense, it's the bare minimum, but it's better than nothing. So it's like, hey, we're going to cover right at the beginning, but then anything after that, you're going to have to cover. It's protection up front. That's faster and easier and like right in those initial phases of treatment. But if anybody has any sort of extended care or like high costs, then basic medical expense is not going to cover it all. So there are three main types of basic medical expense policies. There are hospital policies, surgical policies, and physicians medical expense policies. HSP. So the way that you can remember that is helping sick people. That's a good play on words. HSP, helping sick people. HSP, hospital, surgical, physician. So these basic medical expense policies, typically there are a certain, like only a specific number of doctor's visits or care visits that they will cover. And there's a set dollar amount per visit, and there's a maximum coverage period. So there are more restrictions. It's like, we're only going to cover this many times there. It's only going to be covered for this much each time, and you're only going to have coverage for a certain amount of time. There's an important term for your pre-license exam. You're going to want to know what usual, customary, and reasonable expenses are, UCR expense. These are fees charged by a physician and other healthcare providers that are like typical for staying in a hospital or being associated with being sick or ill. It's called the usual, customary, or reasonable expense. So the first type of basic medical expense policy we're going to cover today are hospital expense policies. Hospital expense policies cover your basic room, board, supplies, ICU treatment, medications, and tests for hospital stays or anything that happens in a hospital stay. There's two basic payment methods for receiving benefits from a hospital expense policy. So if there are claims related to your room and board, the supplies needed while you're in the hospital, ICU, say you went to intensive care unit, ICU charges, medications, and other tests, there are two basic payment methods for that benefit to be paid out. The first I'm going to cover is the indemnity basis. This is a fixed daily amount. So say a basic medical expense policy covers $150 a day regardless of the actual costs. If it pays out on an indemnity basis, then it's going to pay a fixed daily amount regardless of the actual costs. So they say, hey, every day you're in the hospital, you're going to get $150. Or it could be a reimbursement basis, which is going to give a percentage of the actual charges up to a maximum, either a maximum percent or typically a maximum amount. So here's an example. If the hospital charged you $350 a day and the policy paid $150 a day indemnity, then you would pay $200 out of pocket each day. So a basic medical expense is just like some additional help while you're there. Like it's usually not going to cover the whole amount. It's just a little bit to help out. Basic medical expense policies are not where it's at for people who want full coverage, but honestly, I don't even think they're super popular now. Most people are getting comprehensive and major medical expense policies, but you still got to learn about these for your pre-license exam. A lot of times the intensive care unit charges will pay double the room and board benefit. So say you get, there's a $150 a day room and board benefit for a hospital stay. If you're in ICU, then it might pay double that. And there's other miscellaneous hospital expenses could be covered as a multiple of the room and board benefits. So for example, maybe other expenses are covered at 10 times the room and board benefit up to a certain amount of coverage. So that's hospital expense. It's going to cover things when you're at the hospital. You're going to get either a percentage of that stay covered up to a maximum, or you're going to get a specific dollar amount paid to you every day. And if you're in ICU, it doubles, and there's other expenses that come up, then it might cover some of those at a higher percentage as well. So next we're going to talk about surgical expense policies. So a surgical expense policy has three different approaches. These cover obviously costs associated with surgeries, right? There's three approaches: surgical schedule, relative value scale, and then UCR, which is usual, customary, and reasonable. So the first, the surgical schedule, means a fixed dollar amount per procedure. So for each procedure that there is, it's a fixed dollar amount. The relative value scale, what it does is it assigns certain number of units to each procedure. So on the surgical schedule, you may have all these different procedures, and depending on the procedure, you get a certain value amount based on what that procedure is that you take in. The relative value scale assigns different number of units to the different procedures, and each unit has a certain value. So if one procedure gets assigned more units than another one, and the value per unit is the same, then the one with more units assigned to it is going to pay a bigger benefit. So let's say someone has like gallbladder removal. Say gallbladder removal is, we're going to use the surgical schedule example first. So surgical schedule example, say that for gallbladder removal, they pay $150, and for appendix removal, they pay $300. That's surgical schedule, where there's like a chart that shows the different procedures and what each one will receive as a benefit if you experience that. Now, the relative value scale will assign a number of units to each procedure instead. So say they say each unit is worth $10. This is just an example. Gallbladder procedure will receive is 15 units. So 10 times 15 is 150. And then the appendix removal is 30 units, which is 10 times 30 is 300. So in that case, it would pay out the same amount as a surgical schedule, but this is just using the relative value scale. It's just a different way of looking at it. Now, that's just an example I came with off the top of my head. That doesn't mean that insurance companies are going to use that exact thing that I went over there. One insurance company might charge more or pay out more than another for a certain benefit, but I'm just using that as an example so that you can see how it would work. They either assign it a specific value, or they can assign it a certain number of units, and each unit has a value. The third option is our non-scheduled plans, which cover usual, customary, and reasonable charge amounts. Non-scheduled plans are very common in comprehensive and major medical plans. What this is saying is the insurance company determines that based on the geographical area that the insured lives, they're only going to pay a certain amount out for that procedure based on what the physicians in the area typically charge for that procedure. The reason why that's important is because maybe a procedure in Los Angeles costs more than a procedure in the middle of Kentucky, The insurance companies know that. They have to have this so that doctor can't just charge like crazy amount for that procedure and get paid by the insurance company. Like if most doctors in Los Angeles charge $3,000 to have a gallbladder removed, doctor can't go be like, okay, well, I'm going to charge $20,000 for this one and bill the insurance and they're going to pay me. No, they're going to pay what is usual, customary, and reasonable based on that geographic area. Surgical expense policies typically cover things like surgeon's fees, both inpatient and outpatient surgeon fees, anesthesiologist fees, and operating room costs. So it's your surgeries, it's getting the medication you need to go under, and it's the cost for the operating room, like the tools and all the linens and materials that are needed for that. So once again, there's 3 approaches to surgical expense policies: surgical schedule approach or scheduled plan, where there's specific dollar amount for each surgical procedure. There's also the relative value scale approach, where each procedure is assigned a certain number of units, and each unit has a dollar amount that corresponds with it. And then there's the UCR or non-scheduled plans, which go on the usual, customary, and reasonable costs for those procedures based on the geographic area. If this is helping you, please subscribe to the channel, turn on post notifications, and check out the other resources that we have in the description of the video. So the last type of basic medical expense insurance I'm going to cover the physician's expense policies. Physician's expense policies cover medical costs, non-surgical medical costs performed by a physician. So non-surgical medical services performed by a physician. These can be things like maternity services if a woman goes in and is having a baby, could be critical care for if someone has like a heart attack or a stroke and they have to go into the hospital for it and be treated. It could cover mental and emotional health disorders. There could be substance abuse disorders. It could be home-based healthcare, like home healthcare could fall under this treatment. Hospice services, where someone goes to a hospice before they pass away. And it could also cover things like x-rays, diagnostic tests, MRIs, stuff like that. And there's a few other things that they'll cover. Basic physician expense policies, the coverage amount is usually limited. Like they're not going to pay, as much as a major medical expense policy or comprehensive medical expense policy. It's going to be that first dollar coverage to cover a small amount when someone goes in and receives treatment. Now, there is something important to note that with a physician's medical expense policy, an insurance company cannot deny a claim just because services were provided by a physician's assistant. So if a physician's assistant, a PA, provides the services, then those services still need to be eligible for a benefit payout from the insurance company. Another type of medical expense policy that you want to know about is a hospital indemnity policy. This may or may not be on your state's pre-license exam content outline, which, by the way, it's important to find that content outline. So if you're using my course, the outline is built into it. You can search on Google to find the course outline yourself. If you want to take a look at my course, just click on the link in the description of the video. But hospital indemnity plans, they pay a certain amount per day for a hospital stay, regardless of whatever the costs incurred are. And there's certain limitations to it, like how many days it'll cover or the maximum amount of coverage, and pre-existing conditions. It might not cover pre-existing conditions, or there might be an elimination period. So an elimination period means that like someone can't get a hospital indemnity policy while they're in the hospital and have it start paying out. There's like a certain amount of time that has to pass between when they got the policy to when they start filing a claim for the policy to take effect. And that just helps root out adverse selection. They also don't cover pre-existing conditions because they say, okay, if someone's like, okay, I know I'm probably going to have to go to the hospital in a couple weeks because something's getting like worse over time, they can't just buy this policy so that they know they're going to get a payout. It can't be something they already have. And then obviously the elimination period. Elimination period is just, it's like a time deductible where they have to spend a certain amount of time with the policy before it'll kick in. Disability policies have an elimination period as well. An example of that would be if you're in a hospital and say your indemnity policy pays $200 a day, then you get that benefit for $200 a day, and it starts from the day you're in there until the day you leave. And there usually are certain maximum limits to the policy of how much it'll pay out and how long it'll last. There's another type of medical expense insurance. It's called a limited benefit policy. Limited benefit policies are what they sound like, very limited. It's on a specific thing, either a specific disease or a travel accident or something like that. It's super, super specific, very limited. And a notice has to be required with this policy to let the insured know that this is a limited benefit policy. If someone takes out a travel accident insurance policy that covers illnesses or accidents while they're traveling abroad, they have to receive a notice saying that, hey, this is a limited benefit policy. This is only going to cover these things or this thing while you're traveling, or it's only going to cover stuff while you're traveling. Now, payments can be provided from limited benefit policies. They can either be received through reimbursement, so where someone pays a certain amount for medical care and then they file the claim and they get reimbursed by the insurance company, or it can be on an indemnity basis where they pay out a certain amount every day regardless of the cost. They just pay out a certain amount every day. And another type of medical expense insurance are prescription drug policies. So prescription drug policies purchased separate from any other policy will cover the cost of drugs that require a physician's prescription. All right, except this doesn't count those received in hospital or extended care facilities. So this is like your general, hey, I went to the doctor, I'm prescribed a medication, I'm going to go to CVS or whatever your local pharmacy is and pick it up. Drugs that do not require a prescription are usually not covered by prescription health policies or prescription drug policies, except for insulin that's injectable. So like you can't go get like Advil if it's not prescribed, right over the counter off the shelf Advil, you can't have that covered. The one they will cover is injectable insulin that doesn't require prescription. There are some pharmacies that sell certain forms of insulin that don't require a prescription. Also, drugs for sexual dysfunction usually are not included either in prescription drug policies unless it's required by state law that they are covered. Now, typically for prescription drug policies as well, like standalone prescription drug policies, there is a copay that needs to be paid. So when you go to pick up a prescription, there's a certain amount of money that has to be paid, and then the insurance company will cover the rest, and it's usually a predetermined fixed amount for specific medications. There are also, another one are limited risk or dread disease policies. So this is when you get a restricted benefit for one particular disease. So like I'm going to get a dread disease policy on cancer, and I'm pretty sure you have to like survive the cancer to get the payout, or whatever the condition is. Like you have to survive it to get the payout. As I go through this, there might be one thing that I'm getting confused with, but I know limited risk dread disease policies is a type of limited benefit policy that is just on like one specific condition, and like that's all it's covering. So there are a few other types of medical expense policies. There is an emergency first aid policy, which will cover emergency treatment costs. There are mental infirmity policies, which cover mental health issues, and there are critical illness policies or specific disease plans. These are the ones that only pay out if the insured survives. So typically with the survival requirement, say you have a critical illness plan for heart attacks, typically you need to get the heart attack and survive for a certain amount of time after, like 30 days or 60 days or something like that, in order for the plan to pay out. Okay, and now for the fun stuff, we're going to move on to major medical expense insurance. So major medical expense plans cover extensive coverage with high maximum value. So major medical expense plans are the ones that people really want to cover like the most serious conditions, and if those conditions end up being like chronic, right? Here's a real world scenario. So basic medical expense insurance, say if you break your arm, okay, the basic medical expense insurance will cover the cast, but what about the 6-month rehabilitation, physical therapy, and specialized equipment? That's really where major medical expense insurance comes into place. This is, like I said, extensive coverage with high benefit limits. It gives catastrophic protection, so it really protects you against financial ruin, because if something catastrophic happens to you and you're in the hospital for a long time or you need a ton of care, that's a tremendous amount of money that basic medical expense insurance simply won't cover. And this is comprehensive, so it covers both inpatient and outpatient. Inpatient is when you have to stay overnight at the hospital. Outpatient is when you don't have to stay overnight at a hospital. Now, there's 3 key features for paying for major medical expense policies. There are deductibles, co-insurance, and co-payments. All right. There are different types of deductibles. So a deductible is the amount that you need to pay before your insurance will kick in. So if a policy has a $1,500 deductible, then you have to pay $1,500 out of pocket for your expenses before insurance will kick in. There are some different types of deductibles that I'm going to go over here now. These are some types that you're going to want to memorize. Okay, there are flat deductibles. Pay a fixed amount per occurrence. So say you have to pay $500 for each occurrence. There are corridor deductibles, where there's a deductible that needs to be paid after your basic medical expense insurance covers something, if you have basic and major. There are integrated deductibles, where your basic coverage counts towards major medical deductibles. So say your basic medical expense insurance covers $300 and your deductible for your major medical expense is $1,000. Then if your basic policy already covered something, then that $300 goes towards the $1,000 deductible of the major plan, so then you would only owe $700. There could be a per cause, so a separate deductible for each accident or illness. And there could be all cause, so a calendar year deductible. So it's one deductible per year regardless of incident. So that's what most insurance is now, from what I've seen from like plans and marketplace plans. Most of them are calendar year deductibles. So you have to pay a certain amount out of pocket in the calendar year before your insurance company will start contributing. Now, for the co-insurance portion, typically benefits from a major medical plan are issued after the co-insurance obligation has been fulfilled. So you have to pay your part and then they pay theirs. And the coverage is pretty comprehensive. So like say you go to a hospital, you have some sort of illness or injury. It'll cover your room and board, your accommodations, any services you get there, any nursing care you need afterwards, or a lot of it, and any fees from the doctors that you have to see associated with your coverage or your rehabilitation for that incident. Major medical expense plans also often cover hospice treatment, and they usually have a drug formulary. So the drug formulary is a chart and a grid that shows what your copays are, what medications are covered by the plan, and what the expected co-payments are for each prescription and which type of prescription. So usually there's like generic drugs cost this much, brand name drugs cost a certain amount, and so on and so on. Major medical plans can function as an additional plan on top of a basic medical expense policy, or they can be a standalone plan. The most common, what I think the most common type of major medical insurance policy is a comprehensive major medical expense insurance policy. Comprehensive medical expense policies integrate basic expense policies, so some first dollar coverage, and major medical into a single plan. And it provides benefits for almost all medical expenses that could come up. So hospital stays, prescription drugs, surgical procedures, nursing care, physician services, lab tests, all that good stuff. Now, most comprehensive major medical plans have a lifetime policy limit. So there's a maximum benefit that the insurance company will cover. They're often sold as group plans as well. So like I said, they're often sold for, like, if you go to work somewhere and they offer health insurance, this is usually the type of plan that someone gets. And it might be first dollar coverage where it pays right away without any sort of deductible or copay, but most of them do have some sort of deductible that the insured is required before the benefits kick in, but not all of them do. When they're picking out different plans, there are different options available. Typically, plans with lower deductibles and lower copays have a higher premium, so it can be offset, just like car insurance, where if you have a higher deductible, then your premium is lower. Lower deductible, your premium is higher. Okay, deductible is what you have to come out of pocket before your insurance kicks in. Once again, the deductibles associated with major medical plans are flat deductibles. So this is a fixed dollar amount that applies to the loss, and it's just like, say, $1,000. Okay, so this is applied to each occurrence per individual. Sometimes can be called an initial deductible. So it's like, hey, you go to the hospital, this occurrence happens, you have to pay this flat deductible each occurrence. There's also a corridor deductible, which kicks in after your basic coverage is exhausted. So this is only when you have a separate basic medical expense insurance policy, so your basic medical expense covers it, and then the major or comprehensive plan on top of it will have an extra deductible that kicks in before, or has to be satisfied before that extra plan starts paying for it. If this stuff sounds confusing or it's hard to memorize, guys, trust me, this is a lot of information, and it's important to watch this video several times and go through your course and your material, or my course, check the description of the video several times to get this stuff down. There's also an integrated deductible where someone's basic medical expense coverage contributes towards meeting the major medical expense deductible. So for instance, I did an example before, but let's say your major medical expense policy has a $1,000 deductible. If the basic medical expense policy covers $750, then the deductible due would be $250, so the difference. between the two. There can also be a per cause deductible. This isn't as common, where the insured has to meet a separate deductible for each individual accident or illness. So say they go to the hospital and there's multiple things, they might have to have a deductible for each individual thing that's covered, or all cause deductible. This is the more common one, or what I see on my insurance anyway. And this is where you have one deductible that has to be met for the whole year, and that's it. After that, you don't have to pay anything else as a deductible. So say you have a $2,000 deductible, and in March you receive care, it costs $5,000. Then once you meet your $2,000 deductible, insurance kicks in for the rest, and maybe there's co-insurance, so you still might have to pay part of it as co-insurance. But after that, if you have anything happen in April, May, June, July, August, whatever, for the rest of the year, you don't have to satisfy that deductible again. Then there's also a provision called a carryover period. What this is typically in the last 3 months, but what it means is that say your deductible is $2,000 and your policy ends on December 31st. If you pay $500 towards your deductible in December, usually it's like a 3-month look back, so it'd be like October, November, December. If whatever you pay towards satisfying the deductible in the last 3 months of that year carries over to the next year, so that you don't have to like reset the deductible just a couple months after. So the carryover provision allows for the last few months. If you pay your deductible in the last few months, that carries over to help satisfy the deductible for the following year as well. There are some deductibles that are common accident and sickness deductibles. So if there's multiple family members on a plan and there's a common sickness or common accident, it means that only one of those deductibles has to be met for the whole family to be covered. Then there's also a deductible called a family maximum deductible. The family maximum deductible means that if a certain number of family members meet a deductible limit or have their deductibles met, then no one else in the family has to worry about satisfying their deductibles. So that say there's 5 people in a family and the deductible for each person is $2,000. Once a certain amount of family members hit that $2,000 deductible, a family maximum deductible will mean that like once that amount is satisfied, every other family member is covered, so that each family member doesn't have to meet their own individual $2,000 deductible. Next, we're going to talk about coinsurance. So coinsurance is when the insurance company pays a percentage of the claim or percentage of the medical costs after the deductible is paid. This is cost sharing. So this is where the insured and the insurance company each pay a percentage. Now, in order for it to be considered insurance, the insurance company must cover at least 50% of the cost. If it doesn't, it's called the discount plan. It's not actually considered insurance. Once the insured has met their deductible, though, which we just talked about the deductible. So once those deductibles are paid, coinsurance typically kicks in, where the insurance company says, we're going to cover a percentage of this. And normally, the insurance company covers the vast majority of the percentage. So say there's 80-20 coinsurance. So 80/20 coinsurance. That means that the insurance company pays 80% of the covered expenses after the deductible is paid, and the insured only needs to pay 20% of those expenses after the deductible is met. Say a medical expense is $102,000. If the deductible is $2,000, that means that there's still $100,000 left over. In an 80-20 coinsurance scenario, the insurance company would pay $80,000 of that, and the insured would only be responsible, not only, but the insured would be responsible for $20,000 of that. Most major medical plans and comprehensive major medical plans pay a significant portion, either 70 to 90% of in-network claims, a minimum of 60% for out-of-network services. The only ones that don't pay a majority percentage for out-of-network services are HMOs, and HMOs are only, it's considered like prepaid service, I believe, and HMOs, they cover emergency out of network though. But you're going to learn about HMOs, PPOs, and EPOs and all that in other videos and other chapters in your course. Okay, so I'm going to go over a claims example scenario. I'm going to read from it here. So assume that the insured is covered by a health insurance policy that includes a deductible of $750 and a coinsurance clause of $70.30. Recently, the insured was hospitalized for a total of 4 days and incurred medical expenses amounting to $2,100. How much will the insured need to pay, and what amount will the insurance company cover? So first, the insured must pay the $750 deductible before any coinsurance kicks in. So the total medical expenses came to $2,100. The first that needs to be paid is the deductible. So if we pay the $750, we subtract that $750 deductible from the total cost of $2,100, and that leaves us with $1,350 of unpaid services. Now, under the 70-30 coinsurance clause, the insurance company is responsible for 70% of the remaining expenses. So if you take 70% of $1,350, that leaves $945 that the insurance company will cover, and the additional $405 has to be covered by the insured. So what that means is that the insured in this total thing, they'd pay the $750 deductible plus their $405 coinsurance, which would mean that the insured individual pays $1,155 and the insurance company would have paid $945. With medical expense insurance, there are stop loss limits and maximum benefits. The stop loss provision is a feature that caps the total out-of-pocket medical expenses incurred by an insured individual. So stop loss caps the total amount of out-of-pocket medical expenses taken on by the individual. And the stop loss provision indicates that once the insured has reached a threshold of expenses, the insurance company will cover 100% of additional costs incurred. So this means that this is a provision where the insured individual can only spend so much money. At that point, coinsurance no longer applies and the insurance company covers everything. Now, policies often do have a maximum benefit limit that outlines the highest amount the insurance company will pay for covered expenses during that policy's terms. So there are some internal or inside limits that where certain expenses may have restrictions on the dollar amount allocated to specific services or may limit the types of services covered. For instance, maybe a major medical expense policy will only cover therapy for $50 per session, right? For instance, I used to go to chiropractor and they gave me $45 per session. So they didn't cover the whole thing. It was just more like an indemnity plan where they would give me, hey, like we talked about indemnity policies earlier. So for this one, the insurance company would give me a $45 benefit per visit. Sometimes for therapy, it's the same thing. There's also benefit periods. So this is usually the time frame the insured can reach benefit. So normally it's a year. Normally they reset annually, but some policies last up to 2 years. And then there's a thing called a restoration of used benefits. So this is with policy lifetime or annual maximum limits. You can run the risk of reaching the limit and then the insured is no longer able to receive benefits and they simply can't afford it. So restoration of unused benefits provision is it allows for benefits to be restored once a certain limit has been reached. It's usually up to a percentage of the total amount, percentage of the benefits that have already been utilized. And most policies have a restriction on pre-existing conditions, benefits that will pay out for pre-existing conditions. So these might apply to all pre-existing conditions, regardless of whether they're declared for the application or not. But most like government marketplace plans, I believe they take pre-existing conditions. So I think most of them take pre-existing conditions. There might be some sort of elimination period where they can't start the claim right away.